Imagine there's a powerful, almost invisible lever that, when pulled early enough, can multiply your efforts exponentially, creating a future far grander than you might believe possible. For decades, this lever was shrouded in complexity, seemingly reserved for a select few. Yet, something has shifted. Suddenly, conversations are buzzing, articles are trending, and a collective awakening is happening around one profound idea: the immense power of starting to invest young. It's not about getting rich quick, but about building an unshakable foundation for life, transforming potential into tangible security. This isn't just about money, it's about reclaiming control, fostering resilience, and unlocking a future of unprecedented freedom. Why this sudden surge in interest? It's not a coincidence, nor is it a fleeting trend. We're witnessing a confluence of factors: unprecedented access to financial tools, a generational shift towards greater financial literacy, and a growing desire for agency in an unpredictable world. No longer confined to the boardrooms or elite brokers, investing has been democratized, inviting everyone to participate in their own financial ascent. This moment offers a unique opportunity for individuals to harness the forces of economics in their favor, to not just earn a living, but to build a life of intention and possibility. The time to listen, learn, and act is unequivocally now. At the heart of this transformative power lies a concept Albert Einstein famously called the eighth wonder of the world: compound interest. It's the principle where your earnings generate their own earnings, creating a snowball effect over time. Imagine a tiny seed planted today, not just growing into a tree, but that tree's fruits also planting new seeds, and so on, ad infinitum. This isn't abstract theory, it's a measurable, verifiable force that has built more wealth over history than any other economic principle. Understanding and harnessing it early is not just smart, it's absolutely essential for anyone aspiring to financial freedom. The young in investing young isn't just a suggestion, it's the core ingredient that supercharges compounding. Time is your greatest, most irreplaceable asset. The longer your money has to grow and compound, the more dramatic the results become. Starting in your 20s gives your investments decades to mature, allowing small, consistent contributions to swell into substantial sums. Waiting even a few years means you're not just losing those initial contributions, you're forfeiting potentially decades of compounding on those early gains. It's a race against the clock where every year, every month, every dollar invested early compounds your advantage. One of the most pervasive myths that deters aspiring young investors is the belief that you need a significant lump sum to start. This couldn't be further from the truth. In today's landscape, you can begin investing with amounts as small as $5, $10, or $50. The real power isn't in the size of your initial deposit, but in the consistency of your contributions and the sheer duration of your investment journey. It's about building a habit, a muscle, that strengthens over time. Don't let the illusion of needing vast capital prevent you from taking that crucial first step towards securing your financial future. Let's put this into perspective. Imagine foregoing that daily $5 latte or an equivalent small daily expense. If you redirect just $5 a day, consistently, into an investment fund earning a hypothetical average annual return of 8%, the results over a lifetime are astonishing. That seemingly insignificant daily choice accumulates into substantial capital. This isn't about deprivation, it's about conscious choices that prioritize your future self. Transforming a small, habitual spend into a powerful investment stream creates a profound impact, demonstrating that consistent, modest actions can lead to extraordinary long-term gains. Consider Investor A, a recent graduate who, at age 22, commits to investing just $150 per month, the equivalent of our $5 a day example, earning that hypothetical 8% annual return. She maintains this discipline for 40 years, until age 62, consistently funneling that small sum into her future. Her total personal contribution over 4 decades would be a modest $72,000. Yet, the power of time and compounding would magnify this sum far beyond her initial investment. This early start, this simple act of financial foresight, sets her on a trajectory towards remarkable wealth accumulation, illustrating the profound effect of merely beginning. Now, let's look at Investor B. He's equally diligent, also investing $150 per month with the same 8% return, but he delays his start by just 10 years, beginning at age 32. He invests for 30 years, matching Investor A's eventual retirement age of 62. While his total personal contributions over those 30 years would still be $54,000, the missed decade of compounding for his initial investments creates a dramatic difference. This simple delay, this choice to wait, carries an immense opportunity cost, showcasing that the biggest hurdle often isn't the amount you invest, but the moment you decide to start. The numerical contrast between Investor A and Investor B is stark and humbling. Investor A, starting at 22, contributes $72,000 and ends up with a hypothetical $470,000 by age 62. Investor B, starting at 32, contributes $54,000 but only reaches approximately $190,000 by age 62. A mere 10-year delay in starting meant Investor B had to invest $18,000 less, but forfeited a staggering $280,000 in potential wealth. This isn't just a difference, it's a chasm, a profound testament to the unparalleled value of time in the investing equation. The earliest start yields disproportionately massive returns. Another major misconception is that investing requires a degree in finance or an inherent genius for market speculation. This narrative often leaves people feeling intimidated and excluded. However, the most effective strategies for long-term wealth building are surprisingly straightforward and accessible to anyone. You don't need to pick individual stocks, time the market, or become an expert trader. The real genius lies in simplicity, consistency, and patience. Embrace the tools designed for the everyday investor, and you'll discover that the path to financial growth is far less complex than it often appears. For most new investors, the answer isn't actively trading but passively investing in broad market index funds or exchange-traded funds, ETFs. These vehicles allow you to invest in hundreds or even thousands of companies with a single purchase, automatically diversifying your portfolio. Instead of trying to pick the next winning stock, you're investing in the overall growth of the economy. This strategy minimizes risk associated with individual companies and maximizes your exposure to market upturns. It's a set-it-and-forget-it approach that leverages the collective power of the market, offering robust growth with minimal effort or expertise. Enter RoboAdvisors, your personal, AI-powered investment partner. Platforms like Betterment or Wealthfront automate your investment strategy based on your financial goals and risk tolerance. They build diversified portfolios of low-cost ETFs, automatically rebalance them, and even optimize for tax efficiency. This eliminates the guesswork and emotional decision-making, ensuring a disciplined approach even when markets are volatile. For young investors, particularly, RoboAdvisors offer an incredibly user-friendly and cost-effective entry point into the world of investing, transforming a complex task into a seamless, automated process that continuously works for you. The fear of losing money is a significant barrier, often fueled by media headlines about market crashes. While investing inherently carries risk, this risk is dramatically mitigated over longer time horizons. For young investors, with decades ahead, market downturns are not merely risks, they are opportunities. Prices become cheaper, allowing you to buy more shares for the same amount of money. The long-term trajectory of well-diversified markets has consistently been upward, despite numerous recessions and crises. Understanding this distinction between short-term volatility and long-term growth is paramount to cultivating a resilient investor mindset. Diversification is your primary defense against risk. It's the strategy of spreading your investments across various assets, industries, and geographies. By not putting all your eggs in one basket, you reduce the impact if any single investment performs poorly. Index funds and ETFs inherently offer diversification, but you can further enhance this by investing in different types of funds or asset classes, such as bonds or real estate, as you progress. This strategic spread minimizes exposure to individual market shocks and positions your portfolio for stable, sustained growth, regardless of which specific sector is thriving or struggling. History is a powerful teacher. Despite countless economic crises, dot-com bubbles, financial meltdowns, and global pandemics, the broader stock market has consistently recovered and delivered positive returns over the long run. Since 1957, the S&P 500 has, on average, yielded an inflation-adjusted return of roughly 7 to 10% annually over extended periods. This doesn't mean a smooth ride, but rather a testament to the market's inherent resilience and the underlying growth of global economies. Trusting this long-term trend, rather than reacting to short-term fluctuations, is the cornerstone of successful investing, particularly for those with decades to grow. While you fret about market volatility, a silent, insidious force is constantly eroding the value of your savings: inflation. This is the gradual increase in prices, meaning your money buys less over time. If your cash is sitting idly in a low-interest savings account, it's effectively losing purchasing power every single day. With average inflation rates often hovering between 2 to 3% annually, your static savings are depreciating in real terms. Not investing, therefore, is not a neutral choice. It's a guaranteed loss over the long run, subtly undermining your financial stability without any dramatic headlines. Investing is your most potent weapon against inflation. By putting your money into assets that historically grow faster than the rate of inflation, you not only preserve your purchasing power but actively increase it. A diversified portfolio aiming for that 7 to 10% annual return effectively outpaces the typical 2 to 3% inflation rate, ensuring your wealth grows in real terms. This proactive approach transforms your financial journey from a defensive battle against depreciation into an offensive strategy for true wealth accumulation. It's about making your money work harder for you than inflation works against you. Let's truly grasp the power of compounding over extreme lengths of time. Imagine taking a single $100 bill and investing it just once, at age 20, into an index fund earning a hypothetical 8% average annual return. You never add another penny. By the time you reach age 80, that initial $100 would have grown to an astonishing approximately $10,000. That's a 100-fold increase, purely from the magic of compounding over 6 decades. This dramatic illustration isn't about huge sums, but the incredible leverage time provides, turning pocket change into a testament to persistent growth. While the numbers are compelling, the benefits of investing young extend far beyond mere monetary accumulation. There's a profound psychological dividend. Knowing your money is working for you, building your future, brings immense peace of mind and reduces financial anxiety. It fosters a sense of control and confidence, allowing you to approach life's challenges from a position of strength rather than scarcity. This proactive financial stewardship cultivates a positive relationship with money, transforming it from a source of stress into a powerful tool for achieving your aspirations and enhancing your overall well-being. Imagine the options that open up when you've built a substantial investment portfolio. Financial independence isn't just about early retirement, it's about the freedom to choose. It's the ability to pursue a passion project, take a sabbatical, negotiate for better work-life balance, or pivot careers without immediate financial pressure. Investing young creates a safety net that empowers you to make life decisions based on desire, not necessity. This flexibility is the ultimate luxury, providing a pathway to a life lived on your own terms, designed around your values and aspirations, rather than external constraints. Starting to invest young also has profound generational implications. It's not just about securing your own future, it's about creating a legacy. When you accumulate significant wealth over decades, you create opportunities to support your family, fund your children's education, or even leave a substantial inheritance. This power to uplift future generations and provide them with a head start can break cycles of financial struggle and foster lasting prosperity. You become a pioneer, laying down a strong financial foundation that can benefit your lineage for decades to come, extending your impact far beyond your lifetime. While the focus is on starting young, it's absolutely crucial to debunk the myth that if you haven't started in your 20s, it's too late. This belief is a dangerous form of procrastination. The truth is, the best time to invest was yesterday, the second best time is today. Even if you're in your 30s, 40s, or beyond, you still have valuable years for compounding to work its magic.
Every single contribution, every year you invest, still builds wealth. The message is about harnessing time, no matter how much you have left. Begin now, with purpose and determination, and you can still make a substantial impact on your financial future. Beyond just market returns, strategic investing leverages powerful tax advantages offered by various account types. Accounts like 401(k)s and IRAs, whether traditional or Roth, are designed to accelerate your wealth accumulation by deferring or eliminating taxes on your investment gains. Contributing to a traditional 401(k) can reduce your taxable income now, while Roth accounts allow your money to grow completely tax-free and be withdrawn tax-free in retirement. Understanding and utilizing these tax-efficient vehicles is critical for maximizing your long-term returns, turning potential tax liabilities into powerful catalysts for growth. For many, employer-sponsored retirement plans like 401(k)s come with an incredible perk: employer matching contributions. This is essentially free money. When you contribute a percentage of your salary, your employer matches a portion of it. Failing to contribute enough to capture the full employer match is leaving thousands of dollars on the table, year after year. It's an instant, guaranteed return on your investment that no other financial vehicle can replicate. Always prioritize contributing at least enough to get your full employer match. It's one of the simplest, most powerful ways to instantly boost your wealth accumulation. As your income grows, a common trap awaits: lifestyle creep. This is the phenomenon where increased earnings lead to increased spending, leaving little or no extra money for savings or investments. To truly harness the power of investing young, it's crucial to resist this impulse. Prioritize investing a percentage of every pay raise or bonus first, before adjusting your lifestyle. By consistently paying yourself first, you ensure that your wealth compounds at a faster rate, securing your financial future rather than getting caught in an endless cycle of consumption. Maintain your financial discipline even as your means expand. Investing young isn't just about financial gains, it's a powerful crucible for building invaluable life skills. It cultivates discipline, patience, and a long-term perspective, qualities that transcend your portfolio and enrich every aspect of your life. The act of consistently setting aside money, even when temptations arise, strengthens your willpower and teaches you delayed gratification. These are not merely financial habits, they are character-building practices that empower you to make more thoughtful decisions across your personal and professional life. The discipline you apply today will pay dividends in every conceivable way, far beyond the balance in your brokerage account. One of the simplest yet most effective strategies for consistent investing is automation. Set up automatic transfers from your checking account to your investment account on a regular schedule, weekly, bi-weekly, or monthly. This removes the need for conscious decision-making and ensures that you're consistently contributing to your future, regardless of market conditions or your daily willpower. It's the set-it-and-forget-it approach that leverages technology to maintain your financial discipline. Automated investing transforms a potential chore into a seamless, unstoppable engine of wealth creation, working tirelessly in the background. For those who find even small fixed contributions challenging, micro-investing apps offer an ingenious solution. Platforms like Acorns or Stash allow you to invest your spare change by rounding up your everyday purchases to the nearest dollar. That extra 50 cents from your coffee, or 25 cents from groceries, gets automatically invested. It's investing without even feeling it, transforming your daily spending into a subtle, yet powerful, wealth-building habit. These apps lower the barrier to entry to virtually zero, making investing accessible to everyone, regardless of income level. Every penny counts, literally. Beyond regular contributions, be intentional about directing any unexpected windfalls or extra income towards your investments. Did you get a bonus at work? A tax refund? A raise? A successful side hustle payout? Instead of letting that money disappear into discretionary spending, funnel a significant portion directly into your investment accounts. This strategic allocation of found money can significantly accelerate your wealth accumulation, giving your portfolio powerful boosts that compound over time. Every extra dollar you purposefully invest today is a seed planted for a more abundant future, building momentum for your financial goals.
The journey of investing young isn't just about the mechanics, it's fundamentally about a shift in mindset. It's moving from a consumer mentality, focused on immediate gratification and spending, to an owner mentality, focused on long-term growth and building assets. You transform from someone who merely earns and spends into someone who strategically acquires ownership in the world's most innovative companies and resilient economies. This perspective shift empowers you to view every dollar as a potential seed, an opportunity to grow your wealth, rather than just a means to an end. It's a profound reorientation towards your financial future. Investing is a lifelong learning journey, and developing your financial IQ is an investment in itself. The more you understand about how money works, how markets operate, and how different investment vehicles function, the more confident and effective you become. Dedicate time to reading books, following reputable financial news, listening to podcasts, and taking online courses. This continuous self-education demystifies the process, empowers you to make informed decisions, and reduces anxiety. Your financial literacy is a compounding asset, growing in value and impact with every piece of knowledge you acquire, making you a more astute and successful investor. Often, the biggest obstacle isn't a lack of resources or knowledge, but the inertia of simply not starting. The fear of the unknown, the paralysis of perfectionism, or the illusion that you need to know everything before you begin, can be crippling. But remember, the journey of 1,000 miles begins with a single step. Open that brokerage account. Set up that automatic transfer for a modest sum. Download a micro-investing app. Don't wait for the perfect moment or the perfect amount. The power is in the action itself, in breaking free from procrastination and initiating your financial transformation today. Close your eyes for a moment and imagine your future self. Picture yourself decades from now, looking back at this very moment. What would that future you say to the person you are today? Would they urge you to wait? Or would they express profound gratitude for the courage, discipline, and foresight you exhibited by starting to invest young? They would undoubtedly thank you. They would thank you for the financial freedom, the reduced stress, the opportunities, and the peace of mind. Invest in that future version of yourself, because that version is depending on the choices you make right now. Your financial journey, when started young and nurtured consistently, doesn't just benefit you. It creates a ripple effect. As you build wealth and achieve financial independence, you become a source of inspiration and guidance for your friends, family, and community. Your success can demystify investing for others, encourage healthier financial habits, and even pave the way for collective prosperity. By taking control of your financial destiny, you're not just improving your own life, you're contributing to a broader movement of financial empowerment, fostering a culture where everyone feels capable of building a secure future. The confluence of accessible technology, proven strategies, and the undeniable power of compounding makes this an unparalleled moment in history for young people to invest. The window of opportunity is always open, but the rewards for early action are diminishingly available the longer you wait. Don't let fear, misinformation, or procrastination prevent you from seizing this moment. This isn't just about saving for retirement, it's about unlocking a lifetime of choices, security, and potential. The time to act on this newfound understanding, to transform curiosity into concrete action, is now. Let's revisit the snowball effect of compounding with renewed appreciation. Imagine starting with a pebble, rolling it down a long, gentle slope. At first, its growth is imperceptible. But as it gathers snow, its mass increases, and its speed accelerates. The growth becomes exponential, transforming a small beginning into an unstoppable force. Your early investments are those pebbles. Given enough time and consistent additions, they too will grow into a financial snowball of immense proportions. This powerful visual reminds us that patience isn't passive, it's an active strategy that yields breathtaking results over the long haul. Your financial journey is deeply personal, a unique tapestry woven from your aspirations, values, and circumstances. There's no one-size-fits-all solution, but rather a framework within which you design your own future. Whether your goal is early retirement, buying a home, funding higher education, or simply building a robust safety net, Investing Young provides the canvas and the tools to paint that picture. Take the time to define your goals, understand your risk tolerance, and craft a strategy that aligns with your life vision. This is your opportunity to consciously and proactively shape the life you truly desire.
Investing young isn't solely about the distant goal of retirement.
It's about empowering yourself to achieve life's major milestones with greater ease and confidence. Imagine having the down payment for your first home without crippling debt, or the funds to pursue a master's degree without taking out massive loans. Picture having a substantial nest egg for your child's education or the flexibility to take that dream sabbatical. By starting early, your investments can become powerful enablers for every significant chapter of your life, transforming aspirations into tangible realities.
It allows you to approach each milestone from a position of financial strength. So, how do you begin this journey? It's simpler than you think. First, educate yourself just a little more.
Second, open a low-cost brokerage account or consider a robo-advisor. Platforms like Vanguard, Fidelity, Schwab, or Betterment are excellent starting points.
Third, set up an automatic transfer for a consistent, even if small, amount.
Aim for an index fund that tracks the total stock market.
That's it.
Those 3 steps, executed today, will put you on an irreversible path toward financial empowerment.
The biggest step is always the first one, and it's within your reach right now.
Every individual has the power to author their own financial narrative. You are not a passive recipient of economic forces, you are an active participant, a creator of your future. By choosing to invest young, you are taking the pen into your own hand, writing a story of foresight, discipline, and ultimately, triumph. This is your chance to move beyond merely reacting to circumstances and instead, proactively design a life rich with opportunity and security. Let this moment be the turning point, the chapter where you decided to take control and build the legacy you deserve. The widespread discussion around starting to invest young isn't just chatter, it's a clarion call, an urgent invitation to harness one of the most powerful forces in economics. This opportunity, amplified by today's accessible tools, is too significant to ignore. Your future self is waiting, holding open the door to a life of greater freedom and security. Don't let another day pass without taking that first, decisive step. Seize this moment, embrace the potential, and start building the future you envision.
The power is not just in the market, it's in your hands. Ultimately, starting to invest young is the most profound investment you can make in yourself.
It's an investment in your peace of mind, your freedom, your opportunities, and the well-being of those you love. It's about believing in your own capacity to grow and thrive, and then backing that belief with consistent action. The power isn't just about the money, it's about the person you become through the journey, disciplined, informed, and truly empowered.
Thank your future self by taking action today.
Your greatest asset is not just time, but your willingness to use it wisely.